in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. The chip makers plunge. AMD says its return to China is still unknown. Supermicro shares dive after cutting its sales forecast. The big get bigger. OpenAI is said to fetch an eye-watering $500 billion valuation in its latest share sale. And bracing for a tariff blitz, President Trump says announcements on chips and pharma levies are coming soon. Another day of losses for the S&P 500 yesterday. We attempt to rebound this morning. The explanation being thrown out there was a weak services ISM. You can see S&P 500 futures up by about a third. The Nasdaq underperforms with some of those chip maker weakness. Valerie Teitel will get into that in just a moment. Meanwhile, for this bond market, perhaps the worrying thing for those services ISMs yesterday was that prices paid was higher, and you saw a tick up in yields, and that continues this morning. We're up about 1.5 basis points for your 2-year yield. Your 10-year yield, that stands at 4.2414. That's up by 3 basis points. We will be getting a 10-year auction today. Let's get you those stocks to watch. With that is Valerie. Hey, Val.
Good morning, Danny. Let's start right there with AMD. This is the world's second largest chip maker, falling over 5% in pre-market. The company was very hesitant to talk about any China revenue. It seems like they are not convinced they're going to get those export licenses to sell their China-specifically made chip into that market. The market did not like that kind of news, and we're trading down 5%. Remember, AMD, though, is the outperformer when it comes to chip stocks so far this year. So a lot was baked into the earnings last night. Also moving on to Supermicro. This is a maker of AI servers. They sell it to companies like NVIDIA. That stock is getting pummeled in the pre-market, down over 16%. They have continued to rein in their sales guidance. And Danny, this comes after only back in February, they gave a sales number that was nearly twice the analyst estimate. So a bullish figure at the start of the year is being walked back. Investors seem to not like that kind of narrative. Maybe Supermicro is not in the best place to capitalize on this extra CapEx spending. Those shares are sinking in pre-market. Lastly, let's take a look at what's to come. We are hearing from Disney and Uber right before the bell in around 2 hours' time. Disney already trading strongly this morning, up 2%. There was some news overnight that Disney's ESPN is having a tie-up with NFL's media assets. It seems like the stock is liking that news. Uber is also the first of the gig economy to report this season. A lot of attention on their tie-up with Waymo, Alphabet's Waymo, and how that is going. Danny.
Valerie, thank you very much for that. We'll catch up with you later in the hour. Also in this hour, in just moments, Sharon Bell of Goldman Sachs joins us for a read on this earnings season. And later, we'll catch up with Dutta of Renaissance Macro on the U.S. economy and all things Federal Reserve. Now, so far this earnings season, firms have shrugged off President Trump's rewiring of global trade. Sharon Bell of Goldman Sachs writes, quote, while U.S. companies are displaying confidence regarding their ability to weather tariff impacts on profits and earnings calls, cost pressures could increase in the second half of 2025, introducing downside risk to real revenue growth. I'm pleased to say Sharon joins us now. She's Senior Europe Equity Strategist at Goldman Sachs. Sharon, where do you expect, and good morning to you, where do you expect some of those pressures to show up most acutely in the second half of this year?
I think it's difficult to say. I mean, companies so far have been pretty confident, and the U.S. earnings seasons, both the first and second quarter, have been strong. The second quarter so far delivering, again, a very good beat, particularly amongst the biggest cap tech companies that perhaps are not totally immune, but much more immune to some of these concerns on growth and tariffs. But yeah, as you go into the second half, if companies have pulled forward a lot of inventory imported already in the first quarter of this year, they've already started to use all of those. And yes, I think that you may see a little bit more pressure on margins.
Well, to that point, SocGen's Andrew Lapthorne noted at the end of last week, 2/3 of the S&P that had reported were showing declining profit margins already. So this idea that for now they're eating the cost, but Sharon, how long can that continue on? And what happens when some of these firms start to raise prices? Are consumers going to be willing to pay more?
Yeah, I mean, this is the thing. The U.S. economy at the moment is, we describe it as being at stall speed. It's not, it is growing below potential, and we think that will be the case in the second half of this year. And we think that part of that is because of consumer real incomes being so weak, given some pass-through, some higher inflation related to the tariffs. So, and for that reason, we do think the Fed will respond as well come September, and beyond in terms of cutting rates. So absolutely, I think the economy is relatively on the weaker side at the moment. The US earnings season perhaps disguises that a little bit, partly because the weaker dollar is helping the US, but also partly because of those bigger cap tech stocks that are doing well and are more immune to this. But the rest of the market, the 493, definitely you are seeing some issues. Smaller caps as well, underperforming in the US, all related, I think, to some of these pressures.
Yeah, but one of the weird things, Sharon, if you look at the bottom from April 8th and just how the sectors have been doing, all of them have advanced, save for healthcare, which has some of its own idiosyncratic and perhaps also tariff things going on in it. Does that make sense for something like consumer discretionary, for example? That's up 24% from the bottom. Can that last?
Yeah, I mean, the market's rallied a lot since the kind of Liberation Day related lows. But I guess that was on concerns that tariffs would be a lot higher than even we're seeing them come through now. And there is a lot of evidence that's come through since then that there's a lot of pragmatism when it comes to tariffs. So I think a lot of the rally, yes, that bit of it is justified. But to the extent that the rally is suggesting that growth is going to be absolutely fine, I mean, we don't agree with that. The second half of this year, I think growth will be on the weaker side. That all being said, like I said, there's a big chunk of the US market, the biggest cap tech companies that have very good balance sheets that aren't really exposed to these trends that can continue to defy some of these trends, I think. So I think it's a mixed picture. Interest rates coming down as well helps. So even if growth is relatively weak, interest rates coming down, on the other hand, supports investors and markets as well.
Yeah, and maybe that sort of is why there's this disconnect of a bond market that has really started to price in those interest rates and equities that have held up. Sharon, you say pragmatism in tariffs, but there have been threats from Trump, and the most recent of which comes yesterday, where he said that you could see something like 150 or 250% tariff on pharmaceuticals. How are you thinking about that sector and pharmaceuticals in Europe as well, if this is the sort of pressure that they could face if they don't cut costs in the U.S.?
Yeah, absolutely. I mean, there's still uncertainty. I say there's pragmatism, but there's still a lack of certainty. The EU has done a framework deal with the US, but there's still a little bit of uncertainty with respect to the details, and there's definite uncertainty when it comes to pharmaceuticals globally, tariffs they may face given the investigation still underway. So I absolutely think that sort of overhang on the sector continues to kind of penalise the sector. And I don't see, at least in the near term, that going away. The other thing for European pharmaceuticals is they make a lot of dollar earnings, and to the extent that the dollar has been weaker in the last couple of quarters, that's a hit on their profitability as well.
Yeah, it's interesting to see where some of that is showing up. Just thinking of Pfizer yesterday, they basically said, look, our earnings, our sales themselves were weak, but we were cutting costs. We had the benefit of a weaker dollar, and at the same time, we have tax benefits. Sharon, you talk about how some of the pressures are going to show up in 2025, but they get the boost maybe from Fed cuts. But what about taxes? A more friendly tax regime come the start of 2026. How big of a boost could that be to corporate profits?
Yeah, a marginal boost, I think. And, you know, we do have 7% earnings growth for US companies next year, which would be above nominal GDP growth. A little bit of that is the impact of the biggest tech stocks still growing quite nicely, but a little bit of that as well is tax impact, etc. So I do think US earnings can continue to grow, and a little bit is related to deregulation as well. So some tax or continuation of tax cuts and some deregulation all is in the mix and helping some of this better US earnings performance. And slightly weaker dollar, because with the Fed cutting rates, we still believe the dollar will continue to fall, and that will also be a nice tailwind for US profits too.
Yeah, a lot of cross-current forces, Sharon. Hopefully the good wins out. Thank you so much for joining us this morning, Sharon Bell of Goldman Sachs. Let's get you some other top stories now that are trending on the terminal this morning. And as we've been discussing, President Trump says that he would impose more levies, this time higher levies, on countries buying energy from Russia. Meanwhile, the president said that decisions on chips and pharma imports would come within the next week or so. Meanwhile, Swiss President Keller Sutter has been set to hold talks in Washington today on trade. Elsewhere, President Trump has also made comments on his pick for the upcoming vacancy at the Fed.
Fed governor. I'll be making that decision before the end of the week, and we'll either decide on one for permanence or the 4-month period, the term. There's a term of about a number of months. We have a couple of candidates. I mean, everybody wants it, okay? It's not a couple, but we've narrowed it to a couple of candidates. And we've also, we're looking at the Fed chair, and that's down to 4 people right now.
And Glencore has canceled its plans to move its primary listing to New York, instead keeping its London listing. CEO Gary Nagle said that Glencore was unlikely to have gotten into the S&P 500. It's a move that would have been a blow to London, which has lost a quarter of its companies in the past decade. Coming up, AMD and Supermicro shares take a hit post-earnings. We're going to have more on that next, coming up on your brief.
Earlier this quarter, we were notified by the Department of Commerce that it is moving forward with the review of our license applications to export MI308 to China. As our licenses are still under review, we are not including any MI308 revenue in our third quarter guidance.
AMD CEO Lisa Su speaking about the uncertainty that clouds the chipmaker's China business. Let's unpack those earnings and more with Bloomberg's executive editor for Global Tech, Peter Elstrom. Peter, great to see you this morning. And look, this is something that for AMD and NVIDIA was supposed to be a big boost. The fact that they would get the licenses to start selling in China again. How big of a blow is it that they don't yet have that certainty?
Well, maybe let's start with the earnings. I mean, AMD came out with their earnings, and it's a reflection of how high the expectations are for AI right now. They came out; their numbers were pretty good. Revenue grew more than 30%, up to $7.7 billion. They handily beat revenue estimates for the second quarter. They gave a forecast for the third quarter that was actually ahead of estimates too. Pretty strong growth. But as you're talking about, Lisa Su, the CEO, talked about their challenges in China. They took a write-down when the Trump administration put extra restrictions on exports to China earlier this year. Now, Lisa Su is saying that this chip that they designed for the China market, MI308, will be sold into the market at some point, but they haven't been able to get any licenses from Washington so far to be able to sell those chips. So they're not including any of that revenue into the forecast for the future. Now, that does sound like there's upside there. If they do get some licenses, then maybe that revenue forecast would go even higher. But the pessimism around not being able to get those licenses really weighed on the stock, and we're seeing that in the early trading today.
And maybe that's also some of what Supermicro is suffering from, high expectations, up 88%. But Peter, I do want to ask you about OpenAI, a $500 billion valuation, definitely making it one of the most richly valued companies that are private in this world. I mean, this is a big uptick. It seems like there is no stopping OpenAI in its mammoth amounts of growth.
Right. Well, there's an important asterisk here, just to be clear. This is not a primary share sale. They're not selling new shares to new investors. What they're doing here is it's a secondary share sale. They're opening it up so that existing employees and former employees would be able to sell some of their shares, take some money off the table. Now, in the old days of Silicon Valley, this never happened. Venture capitalists did not want to give their founders, their entrepreneurs, extra money. They didn't want to give them hundreds of millions of dollars or billions of dollars because they wanted them to stay very motivated, and they also wanted them to have all of their financial interests in making this a success. These days are a little bit different, though, for a couple of different reasons. One, companies are staying private much longer, so you need to be able to give them some cash. Number two, and this is the bigger issue, really, there's a fierce war for talent in AI right now in Silicon Valley. Companies like Meta, which perceive themselves as a little bit behind in AI, are very, very aggressively going out and recruiting AI engineers. We've talked about this a couple times before. Their superintelligence group is recruiting people with offers of $100 million a year. There's one offer of $1 billion that we've heard about that apparently was rejected. So OpenAI, by doing this, is putting some cash into the hands of their employees. They're going to hopefully be able to retain a bunch more of their employees. They did lose a couple of people to Meta in particular. So this is an effort to kind of reward some of the workforce right now so that they'll stick around. They'll be able to build the business that Sam Altman and the crew want to be able to build.
I guess the question is, Peter, if you're a private company like OpenAI and can increase the cash on hand to recruit for talent, what is there, and is there any hope for someone like Apple that continues to lag behind in their share price? They had a better performance in their earnings, but how do they catch up with this AI talent race when someone like OpenAI can hoover all of it up alongside Meta?
You're touching on one of the big questions overhanging Silicon Valley right now. Apple, of course, tremendously well-respected company, has fallen behind in AI. I mean, talking about companies that perceive themselves as behind in AI, they do need to do something aggressive here. They've talked about their AI opportunity. They just had an all-hands meeting where Tim Cook talked about the opportunities there. They certainly want to be a player here. They're determined to be a player here. It's unclear how that happens exactly. Can they recruit enough talent from the outside? Do they need to make an acquisition, perhaps? There are a lot of AI startups out there that they could look to buy. They have a huge market cap to be able to recruit employees, and they've got a great reputation. So, yeah, Apple certainly, if they really want to be a player here, they have to make some big moves.
Peter, thank you so much for joining us this morning. We'll catch up with you later. That is Peter Elstrom. Coming up, Bank of America tells junior bankers if you take a job somewhere else, you're going to be reassigned. We'll have the details for that war for talent coming up next on your brief. You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning, what's leading on the top publications. First off, we have this one on the Bloomberg. OpenAI in early talks about a potential stock sale for current and former employees. It will give the company a valuation of about $500 billion. OpenAI declined to comment. Next up, the FT is leading with this, that shares of Berkshire Hathaway are underperforming the broader market by one of the biggest margins in decades. Berkshire's Class A shares have tumbled 14% since May 2nd. That is the last trading day before Warren Buffett announced his retirement. Berkshire did not respond to a request for comment from the paper. And on the Washington Post, on their front page, President Trump threatening a federal takeover of D.C. after a former Doge worker was attacked. The Elon Musk protege was injured in an attempted carjacking last weekend. The president said on Truth Social that if D.C. doesn't get its act together, the federal government will run the city. Let's now turn to the talent war on Wall Street. Lenders are pushing back on aggressive efforts to lure away junior bankers. Bank of America is now telling junior bankers to divulge any new employment opportunities, and you might face a reassignment if you've accepted that opportunity. Joining us now is Bloomberg's Tom Metcalf. Tom, what exactly is Bank of America doing?
Yeah, hi. Basically, they are trying to clamp down on what's known as this on-cycle recruitment along with other lenders. So effectively, they're getting their junior bankers to attest that they don't have any other future offers, and if they do, they're planning on moving them, one presumes, to perhaps less prestigious or high-profile roles.
And we've seen this really ramp up, but at the same time, Tom, you've heard from some of the big private capital players say we're going to wait to start our recruitment cycles. Is that not enough? Is the pressure still on from these big banks to retain their employees?
I think so, and I think it just shows just how extensive this on-cycle recruitment has been, and how angry the banks are about it. So we see various lenders react in different ways. JP Morgan's come out and said we will fire people who accept offers within 18 months will join us. You've got Citi and Goldman similarly getting their junior bankers to say, hey, we don't have any kind of future offers out there. And it's a big problem, right? Because you can see why the private equity firms are doing it. It's the best way to get sort of talent trained for the least cost, and so the banks are sort of fighting back. And I think we'll continue to see kind of more movement on this front as the banks again try and just dissuade their newest employees from literally jumping ship as soon as they can.
I guess, Tom, kind of the confusing thing is that the banks have always served as a pipeline for the junior bankers. Maybe in decades past, it was you work at a bank and then you go to a hedge fund. That's changed as private capital has become the hot asset class. Why is this seeming to be an issue now? Or has it always been an issue, but just the focus of who's in the ire of the banks has changed?
I think it's two things. One is it's just become more egregious, right? One of the most extreme examples is people who literally are 2-3 days in to joining jobs at banks are then agreeing to join the private equity firms as soon as their training's done. And then the second thing is, I think, it probably has always been the case in some ways. But yeah, it's just become even more apparent how widespread it is with the growth of private equity. And it's probably reached that tipping point where the banks could just basically take it no more. And even though these private equity firms are obviously gigantic clients for them, they're seeing their own kind of, obviously, talent pool, but also just, fundamentally how they run these firms kind of impacted by such recruitment.
Tom, thank you very much for that. That is Bloomberg's Tom Metcalf. I want to give you a quick check on oil this morning because we are rebounding up more than 1% for both Brent and WTI. It seems like the concentration is Trump's threat to Russian supplies. The threat from Donald Trump has been slapping secondary tariffs on buyers of Russian energy. He said that he could impose those higher tariffs. India has been in particular focus for the president. It could possibly include China as well, though. There's your oil price this morning. Coming up, the search for the new Fed governor. Trump says that his pick will come by the end of the week. We're going to discuss that and more with Neil Dutta of Renaissance Macro. That's coming up next. Stay with us on your Bloomberg Brief. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Wednesday. The chipmakers plunge. AMD says its return to China is still unknown. Supermicro shares dive after cutting its sales forecast. The big get bigger. OpenAI is set to fetch an eye-watering $500 billion valuation in its latest share sale. And bracing for a tariff blitz, President Trump says announcements on chips and pharma levies are coming soon. We are rebounding after edging lower yesterday. One explanation floating around there is a miss on July ISM services that weighed on the S&P, but we're up by about a third. Tech underperforms with some of those chip stocks doing worse. And Russell 2000 futures, those outperform. Yields, though, push higher for a second day. We are still about 22 basis points lower on the front end than we were last Thursday. Still just under 90% odds of a Fed cut. Perhaps also pressuring this bond market was also the ISM data showing heightened price pressures, up by a basis point for your 2-year yield, your 10-year yield at 423.55, up 2 basis points. We will get a 10-year auction today. Let's look at some stocks moving in the pre-market. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start why maybe perhaps those NASDAQ futures are underperforming, and it's because of some weak results from AMD. This is the world's second largest chip maker, really reluctant to give any guidance on China revenue. They're asked repeatedly on the conference call, but unwilling to put a number. It seems like they're just unconvinced that they will get these export licenses in order to sell its China-specific chip into that market. So AMD down over 5% so far in pre-market trades. Staying with tech, let's move on to Supermicro. They sell AI servers and hardware to the likes of NVIDIA. This stock getting absolutely torched in the pre-market, down over 16%. Danny, they are continuing to pull back their sales guidance, and they're having issues with margins being under pressure. Now, remember, Supermicro gave quite a bullish outlook back in the first quarter with sales guidance nearly twice of what analysts had assumed, and they're continuing to walk that back to the share's demise. Let's move on to things that we can look forward to today. Danny, we have two big companies reporting before the bell in around an hour and a half's time. The first one being Disney. Those shares are up already, up 2.7% in pre-market. There was news overnight about a tie-up with Disney's ESPN and NFL's media assets. We also have Uber reporting, the first one of the gig economy to report. Danny.
Valerie, thank you very much. Now, elsewhere, President Trump is ramping up his tariff rhetoric, warning of higher levies for countries buying energy from Russia, also hinting at announcements to come on chips and pharmaceuticals within the next week or so. Joining us now is Bloomberg's Suzanne Lynch. Suzanne, what could we expect from the president?
Yes, more ratcheting up of rhetoric by the president about tariffs. And there are a couple of countries, of trading partners, who are in the firing line here. Number one is India. He's already threatened a 25% tariff on India, and now is threatening more, accusing India of facilitating the purchase of Russian energy exports. And then we also have Switzerland, not a member of the European Union, but the Swiss were hit with a really huge tariff of 39%. And we have seen that the Swiss president is now in Washington. She is due to meet with the Secretary of State, Marco Rubio, today, but no news of any other further meetings with anyone more in the economic or trade space that may be close to President Trump on these issues. So a lot of nervousness around the world about this continuously changing and developing trade strategy coming from the White House.
Elsewhere, Suzanne, the other thing we might get this week is Fed replacement for Adriana Kugler. The president commented On that, let's take a listen.
Fed governor. I'll be making that decision before the end of the week, and we'll either decide on one for permanence or the 4-month period, the term. There's a term of about a number of months. We have a couple of candidates. I mean, everybody wants it, okay? It's not a couple, but we've narrowed it to a couple of candidates. And we've also, we're looking at the Fed chair, and that's down to 4 people right now.
Suzanne, what you looking out for?
Well, what's interesting is that the White House has announced there will be some announcement by President Trump at 4:30 p.m. Eastern time today. So let's see, will it be that or may it be something else on trade? But look, I think the key question is, will Donald Trump appoint someone for this kind of surprise vacancy that could go on and be replacement for Jerome Powell? That's a kind of a key thing to watch there. Obviously, the president has been very critical of current Fed policy when it comes to interest rates, and has made no secret of the fact that he's not happy with Jerome Powell there. So that would be one thing to watch on that. Len, we'll be looking at market reaction. Obviously, anything that is seen as interfering, shaping the independence of the Fed is something that markets will be watching closely, even though I think expectations of an interest rate cut next month have increased since last week's jobs report.
All right, Suzanne, thank you very much for that. That is Bloomberg's Suzanne Lynch. Now, earlier this week, I asked former New York Fed President Bill Dudley about the potential surrounding Trump's appointments at the Fed.
If you have 4 governors all lined up on one side, that gives the chair quite a bit of momentum to get his or her way. But I think the Federal Reserve presidents are going to continue to vote their conscience in terms of what's right for the macroeconomy.
Let's add another expert voice to the conversation. Joining us now is Neil Dutta, head of U.S. economic research at Renaissance Macro. Neil, really wonderful to see you this morning. And there was Dudley earlier this week saying the Fed is under siege, but it's going to be just fine. What are you looking out for with President Trump saying that he's going to make an announcement of Kugler's replacement this week?
Well, I think it's interesting. It's that he's basically willing to sort of appoint someone for a matter of months. I'm curious to see whether they're actually able to speed up the process quickly enough to get someone seated in time for the September meeting. But it's important to know that there still remains a pretty strong well of, participants on the FOMC that are not actually lined up in favor of a cut right now. So whoever President Trump puts in is going to have, a lot of convincing to do of their new colleagues. And I think that's what's important. You can't just go in there and exert your will. You have to persuade people to your side. It's a deliberative body. It's a consensus-building institution, and so, it's important to know that just because the president's able to fill the seat quickly, it's not immediately clear, that person will be able to actually affect the change that he wants.
So does the person itself overall, Neil, make a difference? If it's one of the Kevins, if it's someone else, if it's someone outright political, are you able to just brush it off regardless of who it is?
Well, I think that, we don't know who this person, is this person going to be a Kugler replacement, right? That term is up again in January, so you have to go through this process again. And Powell's term is up in May, and, he may well decide to stay on and, continue the remaining term as governor. That's, something that's possible. There's a little bit of a logistical hurdle here, but I would just say that if it looks like it's someone that's just going in there to do the president's bidding, that person's not going to be able to actually affect the change that he wants, because that person won't be able to convince anybody about their position.
Do you assume, Neil, if I can just jump in, do you assume, though, that the same resilience will hold true with an appointment at the head of the BLS, too?
Well, this is part of the challenge. The timing was somewhat suspect, and as a result, the person that they end up putting in, what if Danny, the data stay weak? What if the employment numbers don't improve? Typically, believe it or not, July over the last number of years, excluding the pandemic, July tends to get revised down. So what if you put someone in there and they tell you sort of the same thing about the jobs market? right? I mean, it's the people aren't exactly enthusiastic about the jobs market when you poll consumers. So now you have your own handpicked person telling you that things are bad. That opens you up to some kind of political attack from the other side that gives it a lot more salience now. So, we'll see. They're trying to pivot to making this about improving the statistics, improving the collection. We'll see whether that sort of line of argument can stick. But I do think that at the margin it undercuts confidence a little bit.
Yeah, it's fair enough. They have been trying to change their message from what President Trump said, although he repeated that it was rigged yesterday on CNBC. Neil, if we could just talk about the data itself, and considering that we could get another downward revision in July, there's been this narrative floating around that you've pushed back on, and it goes something like it's a post-Liberation Day fallout, the weaker jobs numbers that we've seen, and considering things have settled down in tariff rates, we'll get a rebound in August. Why are you pushing back against that?
Well, that assumes that it's the uncertainty around the tariffs as opposed to the tariffs themselves that matter, right? The uncertainty around tariffs have been coming down at the margin. I mean, I think that your own reporter just talked about how there's additional skirmishes out in front of us with a number of countries. But again, that assumes that the uncertainty around the tariffs rather than the tariffs themselves are what matter. And we know that the effective tariff rate continues to go higher over the summer. As the customs agencies align collections to what's actually been announced by the president. So that means that there's more revenue going into the Treasury, which means ultimately that there's more potential for pass-through to businesses and consumers from tariffs. So ultimately that if that's not passed on to consumers, it's just going to mean a margin squeeze for the companies, and then companies will have to deal with the margin squeeze somehow.
Well, this is part of the question. Is the labor market data poor enough, Neil? Is that impact enough to kind of just look through what we might get on inflation? Something like we saw in the ISM's data where you saw weak services, but prices paid was higher. Is the weakness in terms of the labor market enough to look through some of the inflationary threat and get those cuts from the Federal Reserve this year?
Well, I think so. That's why I've been advocating for cuts. I mean, to me, it's just nominal income growth. Nominal growth is slowing, right? I mean, so if you basically have a nominal environment of, barely 4% on a good day, then it's very difficult to see how companies can pass on price increases without finding increasing resistance to the volume of the goods that they're selling. So the risk is that if they end up deciding to pass the price increases on because they think the consumer is in much better shape than it actually is, then you'll see volumes of goods sold come down. So whatever goes into P, price, because of tariffs will come out of Q, quantity. That'll mean that real growth comes under significant pressure in the back half of the year.
Neil, you've also been so excellent talking about some of the AI impact, specifically on what it does to utilities and most people if they have to pay more money. I find this so fascinating because if this is happening at a time when there's a booming stock market alongside an AI boom, you're going to have normal people having to pay more for energy. Is this just like the most regressive economic event that we're about to witness, this AI boom?
Well, some have said that may well be. I will say this is not like the 90s tech boom, obviously. I mean, back then you had a bunch of companies that were trying to IPO, a lot of new companies, and they basically went out and hired a lot of people to show Wall Street like, hey, we're good to IPO. And now what you have are more mature companies spending a lot of money on AI and not necessarily hiring all that much. I mean, ultimately, if investment spending is going to be good, it's going to ultimately lift productivity and real wages, which will help consumer spending. That hasn't really happened as of yet. So in the short run, I mean, you just have to follow the data. I mean, in the short run, there are some costs that are likely to go up as a result of what's happening, and energy is chief among them. So I think you can say. I mean, I think that people have talked about this, but it is kind of crowding out certain areas of the economy, and consumer spending was very weak in the first half of the year, and AI actually added more to GDP growth than consumption in the first half of the year. It's a highly unusual situation.
I wanted to ask you about the risk of crowding out, Neil, but also the risk that the AI boom itself could prevent the Fed from lowering interest rates given some of the forces that you're talking about and some of the inflationary growth that AI could have given its build out?
Well, I mean, look, I mean, there's clearly a wealth effect that's associated with AI. I mean, there's no doubt about that because every time a company announces that they're spending more on AI, what happens? Their stock pops, and because the tech companies have such an outsized impact on the S&P, the benchmark indexes surge. So there is a wealth effect. But hey, guess what? Stock markets have been going up for a while. That hasn't stopped the housing market from being very, very weak. That hasn't stopped increasing slack in the jobs market. If you look at prime age employment rates, they're down. That hasn't stopped commercial real estate outside of data center construction from contracting. So if financial conditions are so loose, why are all these areas of the economy that are sensitive to monetary and financial conditions so weak? So I think there's a distinction here between financial market conditions and the financial conditions that people feel. I mean, if you look at even the Fed Senior Loan Officer Survey released earlier this week, on net, banks continue to report that they're tightening lending standards modestly on CNI loans, CRE loans, credit card loans, and they're also noting that demand for some of these things is also weakening. So I sort of reject the idea that just because stocks are high, financial conditions are easy. That's just one part of it, and again, it's not widely spread. I mean, in terms of the equity wealth growth.
Neil, it's a great point and maybe one of many reasons why your name has been floated around in the Fed sweepstakes. Are we going to have to address you as Governor Dutta next time we talk?
I highly doubt that.
Neil, we should.
Yeah, I would tend to lean against the possibility, but stranger things have happened in time.
Neil, we'd all be so lucky if that is the fate that the cards dealt. Neil, thank you so much for joining us this morning. We really appreciate your time. Neil Dutta of Renaissance Macro. All right, let's get you some other top stories trending on the terminal this morning. U.S. Special Envoy Steve Witkoff has arrived in Moscow for talks with officials today. It comes as the White House is racing to beat another self-imposed deadline of August 8th to resolve Russia's war in Ukraine. Bloomberg sources say the Kremlin might offer Washington concessions that could include halting airstrikes in a bid to avert new economic penalties. Shares of Novo Nordisk declining after its sales showed the weakest growth in 4 years. The Danish drug maker is losing ground to Eli Lilly in the U.S. market for obesity medicines. Its revenue growth of 13% in the second quarter is the smallest gain since 2021. The company had posted a profit warning last week. And Glencore has canceled its plans to move its primary listing to New York, staying in London instead. CEO Gary Nagle said that Glencore was unlikely to have gotten into the S&P 500. A move would have been a blow to London, which has lost a quarter of its companies in the past decade. Coming up, $500 billion. That would be the valuation for OpenAI after a potential share sale. More on that Bloomberg scoop coming up next. Stay with us. This is Bloomberg. You're watching Bloomberg Brief. I'm Danny Berger in New York. The AI sector continuing to heat up. Bloomberg has learned that OpenAI is in early talks for a secondary share sale that could value the company at around $500 billion. Let's bring back Peter Elstrom, our executive editor for Global Technology. Peter, it is some wild growth that continues over at OpenAI.
Yeah, very interesting story. Bloomberg exclusive, as you said. The company is looking at doing this secondary share sale where they will let some current and former employees sell some of their stock. The valuation that they're targeting is $500 billion. That's up from $300 billion just back in March, April of this year when they raised $40 billion in the record fundraising round that they had at the time. So it is a sign that certainly inside the company, they're anticipating that valuation is going to climb quite sharply. We've seen that in the rest of the market, too, with some of the other startups. And it's a chance for them to reward some of these employees who are, in the middle of a very serious talent war right now, where other companies like Meta are aggressively trying to recruit them. It's a way to kind of keep some of those employees inside the house.
And meanwhile, we had earnings after the bell yesterday from AMD. We are looking at shares falling this morning. Peter, I just want to take a listen to what Lisa Su, the CEO over at AMD, said on that. Take a listen.
Earlier this quarter, we were notified by the Department of Commerce that it is moving forward with the review of our license applications to export MI308 to China. As our licenses are still under review, we are not including any MI308 revenue in our third quarter guidance.
Peter, to what degree did that overshadow the other results at AMD?
Well, that was the real concern from investors after the call yesterday. And as you mentioned, we'll have Lisa Su on later on. She can talk more about this. The numbers that AMD reported were actually very good. They beat estimates in revenue for their second quarter. They gave a forecast that was very strong, too. On top of that, now Lisa Su is saying this MI308, which they designed for the China market, hasn't gotten any licenses from Washington so far, so they don't want to count any revenues before they find out exactly whether they're going to be able to sell into that China market. But mostly, I would think that sounds like upside for the company. If they're able to sell some of those chips into China, that would add to the revenues that they've got. This is very similar to the situation with NVIDIA, where its H20 chip had been banned. Now it's allowed to be sold into China. But you need to get a license from Washington before you can actually make those sales. So NVIDIA and AMD, both competitors in this very hot AI chip market, need those licenses from Washington before they can sell into China. Of course, there's a caveat here. China has raised some concerns about whether they want to get those chips. Both the H20 chip, they focused on that really with NVIDIA, but it could affect AMD also. They've said they're not so crazy about getting these chips if they have the conditions that Washington is talking about, where you could track those chips, or there may be some sort of security issues with those chips.
Hey, Peter, really appreciate your coverage this morning. Peter Elstrom there on the chip makers. Now, shares of Disney are rising in the pre-market. Its subsidiary ESPN has announced that it will acquire the NFL network and other media assets in exchange for a 10% equity stake in ESPN. Disney also reports today. Joining us now is Geetha Raghunathan of Bloomberg Intelligence. Geetha, perhaps something that's been in the works for a while, but what is the logic behind this arrangement between the NFL network and ESPN?
Yeah, thanks, Danny. So this has been, as you just said, has been going on for a while. What this really does, and why this is so good strategically from Disney's standpoint, is it really kind of future-proofs ESPN's business. So obviously, ESPN is the dominant sports property, but there is so much of competition that it faces right now, not just from other media houses like, a Comcast, NBC, but also from the tech players. Think an Amazon, think Netflix, think Apple. And so really what this does is, the NFL obviously has media deals right now with all of these players, including Disney, including CBS, Fox, but they do have this, opt-out clause that is this huge overhang, which allows them to get out of their deals after the 2029-2030 season. What this really does is it ensures that ESPN, will probably have, first pick, or it definitely protects their rights in the event that the NFL decides to opt out of those deals with any of their other media partners. I think it's a really good way for Disney to definitely future-proof their business with one of the most well-known and the most popular franchises in terms of sports.
And all of that ahead of their results before the market opened, Geetha. What are you looking for there?
Yes, I think one of the big things, there's definitely been a turn in sentiment, Danny. So, the big things I think that we are definitely looking for are the park segments. So there's been some concern about obviously macro fears, but I think the bigger concern was the opening of Comcast Universal's Epic Universe in Florida, and whether that would have any adverse impact on, Disney theme park attendance. I think it has been much less than feared. I think if there was any decline in attendance, I think it was very, very modest. Generally, what we've heard is that, it's been more additive. More people have actually come into Florida, and it's actually been good for Disney parks. So we're expecting to see strong operating income growth in the parks, high single digits for sure. And then the other big thing has obviously been the streaming business. And, this is the narrative going around all over in the media industry, which is the emphasis on streaming profitability. And we expect Disney to outperform there as well, especially now that they have integrated Hulu, or they completely own Hulu after purchasing the stake from Comcast.
Geetha, really looking forward to hearing you break down the earnings once we get them. Geetha Raghunathan of Bloomberg Intelligence. Again, those come before the bell. Now, here's what else we're looking out for today. Again, we'll get Disney results, but also McDonald's and Uber. Then Fed speak coming from Governor Cook and President Collins and Daly throughout the afternoon. And on the official White House schedule, President Trump is expected to make an announcement at 4:30 p.m. Eastern time from the Oval Office. No further details have been noted, but he said that this week he would announce everything from the Fed pick to the BLS chief. Will we get that? All right, a quick check on markets. As we head to the end of the hour, S&P 500 futures are higher. Higher NYMEX crude with Trump threatening secondary sanctions on buyers of Russian oil. Is that part of what's sending yields higher this morning, too, by 2.5 basis points? 423.55 is where your 10-year yield stands this morning after ISM services were weak with higher prices paid. All right, that's it for Bloomberg Brief. Surveillance will take things here, and you're watching Bloomberg TV.